Let's take a look at the price of gold because you have gold futures that have been seeing a lot of movement here in early action, now trading to the downside. And this comes after the precious metal has actually hit 9 consecutive trading days of intraday record highs. Now, after today's CPI print showed that prices remain elevated, higher than what the street had been forecasting, traders are now starting to hedge their bets while the path to rate cuts remains murky. So here to break all this down and more, we want to bring in Francisco Blanch. He is Bank of America's Securities Head of Commodities and Derivatives Research. Francisco, it's great to have you here. So when you take a look at the pricing action that we've seen in gold since this print came in just a bit high, you have gold retreating just a bit. What does this give us a sense in just in terms of how the gold bulls are looking at this print and what this could tell us about future moves?
Hey, Shanna. So thanks for having me. Look, we've seen tremendous gold buying on the back of central banks, and more recently, there's been retail gold buying in China. But I think we have to distinguish the kind of temporary cyclical rate factors driving gold here from what's more structural. And in the case of gold, I think there's a real big structural trend towards more gold purchases driven by the major geopolitical fracture that we have in the world today between US and Europe on the one side and Russia, China on the other. It's really been central banks, not trusting central banks, that has been behind the buy the dip mentality in the gold market. Now, having said that, people have gotten maybe a little bit too excited, and the expectation of interest rate cuts was maybe adding more longs to the gold trade, which of course are retracing today with the inflation print. That's the story. Inflation print's hotter than expected, makes the Fed less likely to cut in June. Why own gold at this stage? There's better alternatives yielding higher returns, and that's I think the battle, if you like, that we are seeing every day.
What is the pathway for gold then if we don't see the Fed cutting rates until late this year, maybe even Q4 or at some point early next year, the bulk of those cuts coming?
Well, for starters, Bank of America, we have 3 rate cuts penciled in. So we're still calling for a rate cut in June and 2 more in the second half of the year. So based on that, we think gold prices continue to go higher. But there is definitely a challenge for the gold market if the Fed doesn't cut rates this year, or as some people have claimed, if the Fed hikes rates, I think it'll be pretty bad for the gold market and particularly for gold positioning. We've also seen a reflection of some of that in the currency markets, with euro-dollar suddenly softening up towards 109 and quickly reversing that all the way to 107.50, 107.60 as soon as the inflation print has come out. It's not just gold, it's also the fact that higher inflation in the US leads to persistently higher interest rates, persistently higher, stronger dollar, and therefore makes assets like gold less valuable. So there's a risk on that gold trade, and the risk, of course, as you pointed out, is the Fed doesn't cut or potentially hikes.
And then what would that mean then for prices, just in terms of the pressure that we could see? How much pressure could we potentially see?
Well, I mean, I think if the Fed starts to hikes again, I mean, you could see potentially quite a little downside pressure. Although I would expect central banks to come in and eventually put a floor on the market. Central banks are not going to be chasing the gold market higher. They're going to be buying on dips. And remember, here we are looking at the cyclical elements, which are connected to the rates and FX cycle, versus the structural elements, which are a little more driven, in our view, by the fact that Russian central bank assets were frozen after the Ukraine war started, and the fact that we've had some major monetary and fiscal policy mistakes for the last 3-4 years, which led to this inflation wave, and that have left us, frankly, with very, very wide budgetary deficits that the buyers of those European government bonds and U.S. treasuries are a little worried about, to put it mildly. That's the other big issue here at heart.
And then going forward from here, what other commodities then do you like outside of gold?
So we think oil coming into the summer is going to do well. We think oil into the summer months will kind of top out around $95+ a barrel. We think gasoline and diesel are going to go along that. So we'll see a firm run up in fuel prices. OPEC has a strong grip on the market. it's going to be another a bumper travel season, just like we had the last 2 or 3 seasons post-COVID. People want to travel, want to spend money. And also the other commodity that we really like at this stage is copper. We think the copper supply crisis is here. And we also think that copper is going to rip to around $12,000 per ton into next year. Now, the copper story is not only cyclical with kind of lower rates potentially supporting the market higher and a restocking cycle, right, which is really the short-term story. There's also a structural element to copper, which is the energy transition, is the need to upgrade the US grid, the European grid, the global grids need to be upgraded to make them friendlier to renewables and to the electrification of everything, and to the big wave of electric vehicle sales that started a few years back and will continue over the course of the next 5 years.
Yeah, the massive run-up that we've seen in copper prices already has certainly been astounding to watch. Francisco, before we let you go, going back to what you just said a minute ago about crude and the gains that we could see here going into the summer season, the biggest factor driving the price of crude, is it demand at this point, or is it supply, given the fact that we are seeing the increase in geopolitical tensions?
Well, I mean, we haven't, to be clear, we haven't lost any meaningful amount of supply. Geopolitical tensions, interestingly enough, for the first time in a long time, have manifested themselves into more demand. Why? Because ships around the world are having to travel longer routes. They cannot go through the Red Sea. And also, they have to travel faster because by virtue of having to go into much longer journeys, you have to speed up those ships. And that's a good chunk of the upgrades to global demand growth in the last 6 months or so have really come from that. I would say as much as half of the re-rating in oil, incremental oil consumption growth rates has come from that. There is a cyclical element, and why is the Fed not maybe potentially not cutting rates in June? Well, it will be because the economy is doing better and because inflation is stickier and things are ultimately stronger. So there is that element of demand. But I don't think there's a massive kind of supply story building here in terms of supply losses. Now, OPEC has definitely convinced over the last 3 months other members. We've seen Saudi pushing the envelope here and getting other members to contribute reductions in supply in line with the agreements that were made in the month of December when Angola, remember, left the organization with a big splash. So clearly the group is coming back together. There's more cohesion. So there's an element there as well on the supply side that is driven by OPEC. So that also, in my mind, kind of limits the upside because the group will likely want to regain some market share if prices do get to $100 a barrel or maybe a little lower than that.
Francisco Blanch, who is the Bank of America Securities Head of Commodities and Derivatives Research. Thanks so much for taking the time here with us.
Thank you.